Warren Buffett says it the best. Why risk something that you have for something that you don't need?
Yeah, what got you here may not get you through, right?
The theme of this conversation is not running out of money.
Have most people ever even defined some of these things? Meaning like, we need this much money.
We talk with people all the time and go, what's your prediction? What's your prediction? What's your prediction? You know what I say? Welcome to the Financial Leadership Podcast. I'm David Afraimi, CEO and co-founder of BAM Advisory Group. Each week on the show, we're going to talk about how to build lasting wealth, take control of your financial destiny, and lead with confidence in every aspect of your life. We'll also dive deep into what it truly means to be a financial leader for yourself, your family, and your community. Let's go. Today's episode is a big one. We're talking about something that even keeps high net worth retirees up at night. What if I run out of money? And before you think this can never happen to me, here's the reality. Over half of retirees, regardless of their net worth, say they're worried about their savings won't last. With longer retirements, rising costs, unpredictable markets, the fear isn't just emotional, it's rooted in the data. In today's episode, Never Run Out, we're going to unpack where those fears come from, how small missteps can snowball over time, and what you can do now to take control. We'll also share our 3-bucket approach to income planning so you can build a retirement that gives you peace of mind, not more questions. So whether you're just entering retirement or already in it, let's build a plan that works as hard as you have, and let's get into it.
Today we are talking about people potentially running out of money in retirement. And I know right now there's a lot of concern. The markets have been very volatile. And so this topic is very timely today on examples of how to mitigate risk in retirement. You know, oftentimes people don't run out of money all at once. It can happen very gradually over time, like small leaks in a bucket or energy leaks that happen. You don't really notice that they're happening, but they are potentially. And so today we're going to talk about and show you a very hypothetical example of before and after of planning versus, not having a great plan versus having a sound plan in retirement. And so I'm going to turn it over to David, who now has an example. He's going to show you before and after.
Yeah, so we're going to jump right into it. So this is not a client. This is a hypothetical example. Tim and Tami Sample. They have about $2.5 million of investable assets. But anyway, so here we go. We're going to quickly go through the hypotheticals to kind of show you how we're building some of these inputs and outputs. So you can see Tammy, she's got about $750,000 in a 401k. They have a joint investment account, non-qualified account, brokerage account, whatever you want to call it, for about $500,000. And then Tim has a traditional IRA for $1 million, and they have about $250,000 in savings. So let's kind of go through the facts. You can see that Tim is 62, Tammy is 58. Tim wants to retire in 3 years, or they both want to retire in 3 years. Tim's a software engineer. She is a teacher. And for this example, we're modeling out life expectancy to age 90. So essentially, these folks, they want to retire at 65, 61, and, spend money for about 25, 30 years. Their financial priorities, they want planning. They want to plan. They want some investment management. They want to minimize taxes, which we'll talk about. And what we're going to talk about today is one of their biggest concerns. They don't want to run out of money. I don't think I've ever met a client that said, hey, I just want to run out of money. I want to, my money to last as long as I do and my spouse does, whatever. Okay. So here are their goals. They want about $120,000 in income net after taxes. Okay.
David, quick question. When you're working with people in the office, do you find is it rare that people come in and have pretty sound plans? Like, meaning when you go through the questions and you really get to know somebody, because I know you guys have a 3 to 4 step process where you really get to know people. Have most people ever even defined some of these things? Meaning like, we need this much money, we want this much income. Is that rare?
No, it's not rare. I mean, I think it's a mixed bag, just like anything else in life, right? You have people that come to your restaurant, order chicken, people come order seafood, and then people ask you, do you have a vegan option?
Right.
So we have people that have very defined goals. When they want to retire, how much. They actually have budgets. And then we have people who come in and they're like, I just need help with all of this. I don't even know. I think it's more common that more people come in and say, I don't even know how much we can spend. No one's ever showed us. We never learned this in school. My advisor doesn't talk about it. We just don't know. So we call it, sometimes we have to work it backwards, meaning based upon how much money they have, pension, Social Security, investments that they supplement, then we show them a very a predictable way so they could spend money so they don't run out.
Copy that. So in this example, these clients want $120K in retirement from their assets, Social Security, et cetera.
Yes.
To live on. Okay, go ahead.
Yeah. So, and you'll notice here it says leave to heirs zero. This is just the default. Sometimes our clients will come to us and say, I want to give my kids $1 million so we can plug all that in. So let's look at their income. In one of our previous episodes, we talk about our investment philosophy, the 3-bucket approach. We're going to kind of touch upon this as we go through this hypothetical example. But right now they're both working, so they make good money. They don't have any pensions. So really the only defined income source they have is Social Security. And in this example, we're modeling them taking it at full retirement age. Obviously they could wait and take it longer, but for this example, we're going to say full retirement age. And for those of you that may not understand exactly what that is, that's full retirement age is the age that you could take your Social Security without a reduction if you wanted to continue to work. It's not means tested, essentially. The cash flow report is just showing them taking out, we'll kind of go through this together. So the cash flow report, this is a busy report. If you look at the little yellow dot, right here that's highlighted, this is when they're retiring. You're going to see from left to right, their total expenses right there. So I said $120,000, but the thing is that you have to understand there's taxes involved, and all of their money outside of the brokerage account is all pre-tax. So they have to pull out about $167,000 when you model out for inflation. So you can see their total assets, and you go, well, what's this thing in the red? This thing in the red is what we call their income gap. Again, we talked about this in the 3-bucket philosophy in one of our previous episodes. Essentially is that they don't have a pension. They want to retire at 65. We want to wait a few years before they take Social Security. So essentially, they got to pull all this money out of their investments. That's what the red is. So anything in red, when you see net cash flow, if it's in red, that's an income gap. We've got to pull that out of their total portfolio assets. Now, when you look at this, you say, oh, they're going to be fine. They're not running out of money. We're going to bake in some scenarios where what if they retire and they have a bear market? Like if you are paying attention to the world, you're not living under a rock. Markets are very volatile. We don't obviously know what's going to happen. People say there's going to be recession. People say there's not going to be recession. Our current president paused on the tariffs for 90 days. All that means is that as they get closer to that 90 days, if there isn't something passed, there could be potentially a lot of volatility. Like if you're nervous right now, it could get more nerve-wracking later. But anyway, so what in our world, at BAM Advisory Group, we don't like these income gaps, because what it means is that you got to pull your income from your growth bucket, which we're going to talk about in a minute. The growth bucket is tied to the market. And if you're pulling money from your stock market accounts and the market's going down, that has a negative compounding effect. And we're going to talk about the sequence of returns risk here in a minute. We've talked about that in our previous episodes. Please go back and watch that. So essentially what we want to do is we want to solve for this income gap. We want to create a income plan where you can take income from defined, predictable income sources that have intention, investments that are designed for income, and ideally not 100% correlated to the stock market. So now what we're going to do is we're going to bake in a bear market. All right, so we bake in the bear market. And what a bear market means, for those of you who don't understand, is that you've retired, and whether it's right away or the next year or 2 years or 3 years, now all of a sudden the market's going haywire. Right? So here's where so the theme of this conversation is not running out of money. What's one way you could run out of money is if you don't have an income plan, you retire, the markets are bad, we're going through a recession. So we baked in a bear market, right at retirement, so that you can see here that bear market, now all of a sudden, these people have the potential to run out of money at age 89. One thing as a financial advisor, you have to run these analysis. You have to plan for worst case scenarios, because you have to show the clients that in a worst case scenario, and this is only one bear market from age 60 to age 90, generally statistically, there's a bear market every 10 to 15 years, right? We're going to talk about this in some upcoming episodes, but what if we had 2 bear markets? These people could not. So in this situation here, they retire, they have a bear market. You see their assets here going down to the far right. As financial advisors, if this was the case, I would be obligated as a fiduciary to call my clients and say, hey, you know what? That plan we put in place, it's not working too well. You've got 2 options. You got to go back to work or live off less. What would you like to do? I don't think any retiree wants to be called 5 or 10 years into retirement as they're spending money, visiting family, seeing their kids, traveling, playing golf, and go, oh, what do you mean I have to go back to work or live off less? Like from retirement to about 75, 77, maybe 80, that's like your go-go years. That's when you're healthiest. Your health goes down after that. You need a solid income plan because at BAM Advisory Group, we like to say we like to protect what's priceless. What that means, we're protecting your time, your energy, your family. We want our clients to do what they love with who they love and allow our team and our planning to absorb the stress and worry when the world gets sideways.
Would you also say too that it is oftentimes not just bear markets, but other life events that people just don't factor into these plans that you know, create significant stress on those?
Yes. So for example, I can think of one.
Not a real client.
Not even a real
just
client.
A hypothetical life example.
I'm thinking about a hypothetical life example. Maybe you've got to help out a child. Maybe your daughter, I don't know, unfortunately gets a divorce and she was dependent upon her husband's income. And the next thing you know, you have to supplement her life. You want to help her buy her house. You have a unplanned expense of $100,000 or $150,000. Where are you going to get that money? Is that money all tied to the market? Is there taxes involved? Those one-off scenarios, which is, by the way, is called life. It's normal. As a financial advisor, we have the tools to plan for that. So if it happens and you communicate at a high level with your advisor, we can plan ahead of time to make sure you just don't grab the money and do something that you're not aware of.
Yeah.
Yes.
Yeah. I mean, it's planning to not be reactionary, which, you know, you read any book on finance, you listen to Warren Buffett at any level. Yeah. Reactionary is no way to plan for anything really. Right. I mean,
no. What's the great quote? And I don't know who did it, is if you fail to plan, you plan to fail.
It was probably Patton or somebody cool like that. I don't know.
That's like Patton. The simplest quote, but doesn't it make sense?
It's fantastic.
You can apply it to all parts of your life.
Yeah.
Today we're talking about your money.
Yep.
Okay, cool.
So are you going to go through additional?
So we're going to show you a potential solution.
Okay.
How BAM Advisory Group, how we do our planning, right? So, because what we want to avoid is you running out of money, which here at 2052 shows you running out of money. Okay. So really what we build is a defined income strategy or volatility control strategy. We're still going to compare it to a bear market. So this is apples for apples. And then we're going to explain what defined income volatility control. And we're going to go back real quick and talk about our 3-bucket philosophy. So now if you look at it, right, they retire.
So this is a whole new illustration showing hypothetical example of how you've prepared for
this proactively.
Okay.
Proactively, somebody will meet with us hypothetically, and we'll say, okay, well, if you're going to retire in 3 years, we've got to do this with your money.
Copy that.
So this is their current situation right now with the bear market, right? Running out of money. This is our planning style, defined income volatility control with the bear market. So it's apples for apples. And what you're going to notice, yes, in 2028, their accounts go down because they have some of their money, but you notice the dip isn't as severe, right? And then to the right, they're not running out of money. I mean, we still have potentially $2 million at end of life versus here, if you didn't make any changes and all of your money was in the market, you ran out of money at potentially 89. I mean, I don't have to ask you what scenario you like better. You know, Warren Buffett says it the best. Why risk something that you have for something that you don't need? You need to go from when you're working, you're in accumulation mode. When you are 5 to 10 years from retirement, you need to think about distribution mode, and your assets have to be reconfigured. It's a different plan. It's a different set of skills your advisor has to have.
Yeah, what got you here may not get you through, right?
What got you here today will not get you where you want to be. That's the greatest thing. We should quote that.
Trademark.
Hashtag.
Trademark.
Make money. T-shirts. Billionaires. We're working too hard. What are we doing? Let's just hashtag make sure.
No, we just need to do more shows, and then we'll come up with more trademarkable things, and then, off to the races.
So what I would like to do is go through the 3-bucket scenario so you can kind of see what all of this is right here. If you're watching this, you're asking, well, how did your planning work so much better than if we just were withdrawing money from your assets? So most people are taught a 1-bucket approach. A 1-bucket approach is when you're ready to retire and you want to supplement your savings, your investments with pensions and Social Security and what other defined income that you have, most people are taught to just pull that supplemental income from their stock market account. But we just showed you if you do that during a bear market, it could have problems. So we have here, which is called a 3-bucket approach. My handwriting is not great, so just apologize. So here we go. Our 3-bucket philosophy. Okay.
Looks like a ransom note.
I'm better with words than I am spelling. So the first bucket is your protection bucket. All right. Here's where you just want emergency money. So again, things that you can have in your protection bucket, you want 6 to 12 months. Well, 6 to 12 months emergency reserves, any emergencies that pop up. Here you're looking for cash, CDs, money market. This isn't a bucket that an advisor should manage. The next bucket is, without question, in our humble opinion, the most important bucket that you need to have in retirement. This is your income bucket. All right. So these clients wanted $120,000. Ideally, and if they have enough assets, you want to get 100% of whatever you want as your paycheck in retirement. If you think about when you were working, you had a consistent paycheck every 2 weeks. Who in the hell wants an inconsistent, unreliable paycheck when they're not working in retirement, right? You actually, in retirement, you want more consistency. You want more income that it's reliable, that's predictable. So here your income again should be reliable, predictable. And the key is try not to have this money 100% correlated to the stock market. We'll talk about that. So you might, well, David, how do you do all that stuff? Well, you got Social Security, you have pensions, right? There's a lot of things you can put in here. You can use annuities, you can use bonds, you can use structured notes, you could use dividends, rental income. We can go on and on and on and on. Okay. So then your third bucket is your growth bucket. This is where you have money for long-term growth, LTG. Things like inflation, taxes, healthcare are wildly unpredictable and super expensive. So you got to have money for long-term. You don't want to be touching this money for 5 to 10 years when you retire. Okay? Period. End of story. So what goes in here? Stocks, any alternatives. You could put Bitcoin in here. You could put ETFs, exchange traded funds, REITs, anything that goes up and down for long-term growth. So the challenge for that couple that we talked about is that they only had Social Security. So their defined income, they wanted $120,000. Okay. They only had, 70 for Social Security. So their income gap was 50 grand. What they were going to do is take that whole $50,000 from here. But when the market goes down, no bueno. So the key is to move money from here, right? And we're going to show you an example here in a second, and to create more predictable income because they didn't have a pension. A lot of you that are watching this that are probably in your 50s go, wait, I don't have a pension. Maybe you have some rental income. But we've got to create more intention because in retirement, you want your $120,000 or $10,000 a month coming to you predictably, reliably, without stress and concern as much as you can. You don't want to have to deal with having to guess when the market is, because if you have to sell stocks that are going down, and we're going to show you here in a second the sequence of returns risk, why pulling money from your supplemental income needs from the stock market are risky. We're going to show you why that is, because you can't time the market.
So David, that's 3 buckets. You mentioned sequence of returns. What is sequence of returns, and how can people understand that in an easy to digest?
Yeah. And we have a hypothetical illustration here to show you the power, or not the power, what sequence of returns means. Meaning sequence of returns means you don't know at any given time what the stock market's going to do. And if your supplemental income plan is to withdraw from your stock market account, we can show you an example here where that could be devastating.
So David, right now, again, this is hypothetical. Right now, the market's been up, 2 trillion in a day, down 3 trillion the next, up a half a trillion the next day, or 10 points or 10%. You're saying right now, if somebody's money was all in the growth bucket and they were taking income out of that right now, that poses a significant danger potentially to them because of the ups and downs. If they pull out when it's down one day or 1 month or 1 quarter, it significantly impacts retirement. So right now, this is particularly important conversation to have because that's probably what's happening to a lot of folks.
You've heard of the 4% rule?
Yes.
So most advisors follow this 4% rule, which we're going to debunk here in our perspective. And the 4% rule is this: as long as you don't pull out more than 4% of your portfolio, you'll be okay.
I have so many things to say about that.
Okay, well, check. Hey, if you've been paying attention to the stock market,
what a great strategy.
Do you know that the S&P 2 times in the last 2.5 weeks has dropped more than 4% in one day?
Yeah.
So you need, so if you're supplementing with 4%, you pulled that out, and then the market dropped 4%, 2 times. The S&P, you're kidding me, right? So here's in this example.
That changes the math for your lifetime now.
Well, we're going to show you.
Yeah.
This is a hypothetical example. This isn't clients we work with. So in this hypothetical example, these are 2 people that have $1 million each in a portfolio. They need 4% of the million, or $40,000 a year, to supplement with their Social Security and pensions to get them their desired income. This person, hypothetical person number 1, retired in 2000. If you go back to 2000, the beginning of the decade, the stock market was negative for the first few years. This was the dot-com bubble, right? So you'll see their $1 million portfolio, right? They're pulling out 4%. We're modeling a 3% inflation, so you have to take more withdrawals. 9 years later, that $1 million is $423,000. They're no longer pulling out 4%. This is like 12%. You can't maintain that. Now,
explain why. That's a good. You're talking about adjusted for inflation, living expenses.
Well, the market has dropped so much that now their portfolio, their income needs haven't changed, but their portfolios dropped dramatically to where now for their inflation adjusted income needs, and when you couple that with how bad the market has been and your portfolio is just nosediving, to maintain your income, you now have to pull out almost 13% of what your portfolio value is to maintain your income. Now you're at a point where it's like, okay, you have to take on more risk or pray to God the markets are going to bounce back, or the options are you have to live off less or go back to work. Nobody wants to do that. Now, example number 2 here is just, it's the same situation, $1 million portfolio, they need 40,000. But they retired in 2010 versus 2000. And you see in that decade, the market was bad only once, and their $1 million portfolio turned into 2.5. The variations between these two things is the true definition of stress, uncertainty, and anxiety, right? If you have a defined income plan, which we just showed you a second ago, it is your best potential way to mitigate this problem. It's the best way to mitigate this problem, okay? Now we're going to tie all this together. So we're going back to Tim and Tami Sample. We're going to show you, again, hypothetical situation, not our client. We're going to show you how we solved for this problem in our defined income scenario. So when they came to us, here's their 3 buckets, right? In their protection bucket, which is their cash bucket, they have $250,000. They needed 120 3 years from now. So when you factor in inflation and taxes, it's actually 174 that they need to pull out to net 120, right? We're using Colorado, state income, federal income taxes, all this other stuff. The only income that they were going to have when they were going to retire was, basically Social Security, right? And then Tammy takes her Social Security later. So they had a $144,000 income gap. Again, their original plan was they're going to take it all from their growth bucket. That wasn't going to work. One bear market really puts a damper into that. So what we just said, this is what we're going to do. The idea is moving how much money do we need to move from growth to income so that when the market goes down, they have more predictable, reliable income. And the answer is simple. We just move we move about 1.5 million into income for them, right? Now they're going to have essentially all the income that they need and want. We've de-risked their portfolio. We talk about what are we doing in this defined income bucket? Again, we can use multiple strategies. We could do bond laddering. We can use structured notes. We can use dividends. We could use annuities. Whatever the client's risk level is really going to determine what strategies we use. But like when you're working with an advisor who focuses on distribution, we are so well equipped with tools and strategies and solutions to provide you the outcome that you want, which is you live your life, protect what's priceless, do what you love with who you love. And then, of course, in the growth bucket, there's going to be volatility there, but you're not dependent upon that to live off of. You tap into your growth bucket as a life enhancer. If you want to go on a trip, you want to stay in a 5-star hotel instead of 4-star hotel, you want to fly business class instead of coach, you want to go eat at, Capitol Grill instead of Outback Steakhouse. No offense to Outback Steakhouse. It's a good, decent steak, but like when you have 25 years to live, you should be eating the best steak possible.
I could not agree more. I don't think that was underselling Outback Steakhouse. They need to step their game up. And so this is how we plan for not potentially running out of money, right? Like, so yeah, bring it home, David. Give us the close. What's the close here?
The close is like people always come to we talk with people all the time and go, what's your prediction? What's your prediction? What's your prediction? You know what I say? I would fail you if I thought something was going to happen and that's the way we did our work. We build into your plan when you come to us that the markets are going to be crap at some point. So we're proactive. So it doesn't matter tariffs, no tariffs. China's going to bomb us, not going to bomb us. COVID, more COVID. This, that, whatever. What is the next thing? There's always something.
Robots.
AI. Everybody's dying. It doesn't matter what happens. Swine flu.
Swan flu.
Yeah,
they're going to upgrade it.
Okay. Whatever the next thing is going to be, Y2K.
Could be Y23.
Whatever's going to happen, it doesn't matter because our plan has already built in what ifs in the world that happen, and you just stay retired, stay spending your money, stay loving, protect. This is how we protect what's priceless for our clients. Once again, this is David Afraimi, co-founder and CEO of BAM Advisory Group, also a licensed investment advisor representative. If you would like to see how we help our clients protect what's priceless, how we've helped our clients for the past 25 years, please visit our website at www.bamadvisorygroup.com and schedule a no-cost, no-obligation meeting with one of our advisors. If you're enjoying the content and you're enjoying the show, please like and subscribe. Thanks again, and we'll talk with you soon.